Hello and welcome. This is Kathleen Oviedo, and I will be your host for today's webinar entitled 5 Military Home Buying Must-Dos and 5 Things to Avoid. Joining me today is Rick Maines, Inside Sales Manager for AAFMAA Mortgage Services, and he'll be sharing just about 30 minutes of slides for you today. At the end of the presentation, Rick will answer any questions you may have. Please ask your questions by typing them into the questions block on your screen. This monthly webinar series is brought to you by AAFMAA Mortgage Services LLC. We are a wholly owned subsidiary of AAFMAA, offering a full spectrum of mortgage products to the military community. Currently, we conduct business in Alabama, Colorado, Connecticut, Delaware, Florida, Indiana, Iowa, Kansas, Kentucky, Maryland, North Carolina, Oklahoma, Pennsylvania, Rhode Island, Tennessee, Colorado, and Virginia. And we will continue to open offices in states across the country. The AAFMAA Mortgage Services team consists of state licensed loan officers. Among all of our professionals, we have decades of both military and industry experience. We are an equal housing opportunity lender, and for your record, our NMLS is 1423968. As a wholly owned subsidiary of AAFMAA, we operate with the same values and priorities of our parent company. AAFMAA stands for American Armed Forces Mutual Aid Association and is the longest-standing not-for-profit association that empowers military families with affordable financial solutions. We accomplish this by being the premier provider of financial planning, investment management, and trust services for the military, not-for-profit. This presentation is educational. It's for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your home purchase decisions. Since each individual situation is unique, the type of loan that benefits you the most will not necessarily be the same as another current or former service member. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. I will now go ahead and turn it over to Rick, who will go over the agenda.
Thanks, Kathleen. Good morning, everybody. So the agenda for today is going to be what I call the list of do's and don'ts of the home buying process. And I've broken it down into 5 do's and 5 don'ts. And now the do's are pre-approval, finding a realtor, learning ways to save, approval conditions, and bank statements. And then the don'ts are your job status, credit, new credit, cash, and the mover schedule. So for the first do, that's applying for a pre-approval. And it's really, really important that you apply for a pre-approval prior to looking for a home. What a lot of people tend to do is start looking for the home before getting a pre-approval from a lender. And that's kind of putting the cart before the horse, because getting the pre-approval first helps to avoid falling in love with the home that you can't afford. Plus, it gives you an advantage in negotiating offers when you're going up against somebody who hasn't gotten their ducks in a row on the financing side. And also, any good realtor is going to request that you do this prior to showing you any homes. And that's because a realtor's job is not to show houses contrary to popular belief. It's to show houses to prospective buyers. And without the pre-qual letter, you're not really a prospective buyer in the seller's eyes. Plus, this helps identify potential problems on the financing side prior to going under contract. Because being under contract is going to be stressful enough on its own, and this will help you position yourself to have a much, much smoother process from contract to closing. And best of all, the pre-approval is free and doesn't obligate you to anything. Next, find a good realtor. Now, there's an old adage, a client who represents himself in court has a fool for a client. And the same holds true on the real estate side to a certain extent. Don't hire an amateur, which would be yourself. A good realtor is worth their weight in gold. And when you do find a good realtor, consider a buyer-broker agreement with your realtor so that they represent you in the transaction instead of the seller. And your realtor is going to use their resources to help you find the perfect home. And remember, they don't get paid until the close of the home, until they succeed in not only finding you a home, but actually navigating you toward closing. And keep in mind that the agent on the for sale sign works for the home seller and not for you. So when you're out there doing your online searches, resist the temptation to call that agent that pops up for the particular house, because they're not going to be representing you. You want to have your agent, and when you find that house, get your agent to go to bat for you, arrange the showings, et cetera, et cetera. Another do, find ways to save. Between the time that you talk to a lender the first time and the time that you go to closing, one of your primary focuses should be save, save, save. Live lean and mean. Cut out the wants and just focus on the needs. And the reason for this is the more assets you have, the stronger your loan is and the better chance of a loan approval. Plus, you are better able to overcome any unexpected expenses that come up along the way, or if your homeowner's insurance ends up being more than you expected. Having that additional money in the bank positions yourself, and even if you don't use it, it allows you to have funds set aside to furnish the home after closing and make that house your home. Do provide bank statements. I think if you ask any loan officer out there, one of the biggest areas of frustration is obtaining bank statements from borrowers. And part of the reason is due to the technological advances we've had in online banking, because a lot of borrowers believe that if they bank online, they don't have access to bank statements. So what we were asking for from borrowers is all pages of either the electronic version or what would be mailed to you in the mail each month that shows the account activity for that month. Also, be prepared to document any large deposits other than your pay stubs or automatic deposits into your account. It's critical that you do not provide account histories, because 99% of the time, the histories cannot be used because they don't show the bank account holder information. They don't show a running balance. They don't show the information that we need to meet the guidelines of the investors. And then what ends up happening is just repeated requests for the same document that adds to frustration of the loan process. So you're better off anytime anybody asks you for anything bank statement related, look for the link online that says statement. And 99% of the time, save that as a PDF, forward that to your processor, your loan officer, you're good to go. Now that we've gone over all the do's, let's focus on the don'ts. Don't change jobs without notifying your loan officer or your processor. And the reason for this is your loan is being underwritten and approved based on the information on the day that you apply. And that part and parcel of that is the job that you have when you apply for the mortgage. At a minimum, changing jobs will require additional documentation because we have to redocument your income on the new job. It will most likely delay closing because more than likely you're going to have to provide your first pay stub from the new job, possibly even two. So you really want to avoid any job changes between the time that you apply and the time that you close on your loan. Now, that's not to say that you can't do it, because there are some situations where it actually helps you, but you just want to make sure that you go over it with your processor and your loan officer so that they can determine whether or not it's going to be a problem. Don't pull your credit. Now, please don't allow anybody to pull your credit if at all possible. Pulling credit can temporarily lower your credit score. It can delay closing. And a soft credit pull is pulled prior to closing to ensure no new debts have accumulated. So if credit is pulled, please notify the loan officer and processor immediately, because they're going to have to make a determination whether that resulted in new credit. It's very, very important, because if credit score is dropping 2 or 3 points, depending on the situation, can dramatically impact not only the terms that you get on your mortgage, but could impact the loan approval itself. So please don't put yourself in that position. Now, another don't that kind of goes hand in hand with the pulling of credit is don't open new credit after you apply. This 9 times out of 10, it will delay closing. It may result in a loan denial, just like having your credit pulled, and it definitely will lower your credit score. So don't put yourself in that position. And if you do, make sure that you let your loan officer and processor know, because we're going to need to get the new account information, and we're going to need to add that to the credit report, and most likely re-pull credit to make sure that your credit scores haven't dropped significantly. And one other word to the wise: avoid the natural inclination to furnish your house with a 10-month or 12-month same as cash offer. That does constitute new credit, even if you're not making any payments on the card for 12 months. Okay? Don't put cash into your account. And this is really, really important, because in the lending world, cash doesn't exist. It doesn't exist because there's no way to tell whether that cash comes from the seller, from your realtor, or from an acceptable source. So the best advice is, if somebody gives you cash, or you have a yard sale and you make $500 at the yard sale. It's a good yard sale, by the way. Use that cash to buy groceries, to buy gas, to go out to dinner. Don't put that in your account. Let your paychecks build your account balance, not that cash deposit. Putting cash in your account will delay the closing, and it reduces the amount of assets available to closing. That doesn't really make sense to a lot of people, but the reason it reduces your assets is because, since we can't source it, we have to subtract that from the balance on your bank statement, thereby reducing your cash to close. Now, this is a tough one, and it's not an absolute, but don't schedule your movers for closing day if at all possible. And the reason for that is that by doing so, you put yourself in a position 9 times out of 10 where if anything unexpected happens, you're scrambling trying to figure out what to do with the movers who are going to be moving your property into a house that you don't own yet. Most of the time, the sellers will not let you do that until you actually own the house. So I'm a big proponent of always having a backup plan in case the expected doesn't happen. Because closing delays are common, even though most of the time they're no fault of the borrower. And the loan process, the home buying process is stressful enough, so don't add stress to an already stressful situation. So that concludes the formal presentation. Do I have any questions?
Thanks, Rick. Yeah, that was very informative. And while you were presenting, we did have several questions come through, so let's address some of those now. First question, why is it important to not pull credit during the mortgage loan process?
Yeah, the main reason is because when you pull credit, it becomes a huge unknown, okay? And that's the reason that it impacts your credit score in a negative way. Because there's no way of telling from that one credit pull whether it resulted in new credit. And if it did, like if you went out and you bought a car, obviously that new car payment is going to impact your ability to repay the loan. So your score is naturally going to drop temporarily until that new account has time to season. And from the loan perspective, we need the time to determine whether it impacts your ability to pay. So I hope that answers the question.
Great.
Good
How
question.
closely do you work with the realtor throughout the process?
Well, keep in mind that you, the borrower, are our client. So our first obligation is to you, because that's our fiduciary responsibility. But that having been said, the realtor, your realtor, the listing agent, the buyer, and me, the lender, we all work as a team that's trying to achieve the same goal. We all want you to close on the house and close on time. So we keep them in the loop, much more so your agent than the listing agent. You know, the listing agent, we advise of the particular milestones, but your agent is advised every step along the way when the major milestones are hit. If we run into any hiccups on the loan, you know, we will discuss it with you first, and typically with your permission, we'll discuss it with the agent. Good question.
Great. When do I actually know I have the loan and the house is mine?
That's a great question. That's the $64,000 question. I have always answered that question with my buyers. It's kind of funny in a way. You own the house when you've signed all the documents and the keys are in your hand. And I know that's a little tongue-in-cheek, but it really is the truth, because up until the day of closing, stuff can happen, and you would not believe the things that have happened that have derailed closings. I actually, early on in my career, I had a seller pass away the day before closing. So you just never know what can happen, and that's why you always want to keep that backup plan that I mentioned earlier. So the answer is, when you have the keys in your hand and you signed all the documents. Now, that having been said, usually when you're clear, when I call you and I say, congratulations, the loan's cleared to close, at that point, 99% of the time, you're going to be good to go. Okay?
Great. What happens if I get a better job while I am trying to buy a house?
Yeah, I sort of touched on that earlier. If you get a better job, more than likely, the two things that we're concerned with is the impact on the closing date, because you have to have started the job prior to closing on the loan 99% of the time. And the biggest concern is the way that you are compensated. So if you get a better job offer in the same field and it's a salaried position, you're probably going to be okay. And at that point, we're probably just going to say, okay, we may have to adjust the closing date and see if the seller's okay with that. But if you go from a salary job to a commission job, that could potentially kill the deal because we can't use commission income for 2 years. So that's why I say it's a case-by-case basis, and there are no absolutes in this industry. But the best advice is if you get a job offer, discuss it with your loan officer and processor before you accept the position. Any more questions?
One more. What is the best way to build my credit?
Unfortunately, there is no crystal ball answer to that question because typically bad credit is not built overnight, nor is good credit. The best way typically to build your credit is through time, because once you've addressed the things that are causing the bad credit or the less than stellar credit, you need time to have your credit score rebound and reflect a good payment history after a less than stellar history. And if your issue is a lack of credit, then you still need time for your new credit accounts to build good credit. So the short answer to that is time. But that's a really good question, and that's one that I get all the time.
Great. Thank you, Rick. Those are some great questions. If we didn't fully answer your question, or if you think of another question later, please reach out to us at mortgage@afma.com, or you can email Rick directly at rmains@afma.com. We'll go ahead and break here for now, but you can reach us whenever you need to. Please don't hesitate to ask for help. We do this every day for our military community, and it's our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. You can always register for future webinars and review past webinars at afma.com/webinars. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AAFMAA. Thank you again to everyone listening and for joining us today. We look forward to our next opportunity to assist you.